Hello and welcome to this session. This is Professor Farhat. In this session, we're going to look at adjusting entries as well as the closing entries for a merchandising company. Now, adjusting entries are generally the same as the service company, which are, if you don't remember, hopefully you do, which are the deferred expenses, deferred revenue. Remember the deferred expenses, deferred revenue, accrued expenses, and accrued revenues. In addition, we might have an additional adjustments because we have inventory. So that's the additional adjustments that we might have we're going to learn about today. So it involves adjusting inventory and cost of goods sold. What are we discussing here? Well, remember, a service company don't have inventory. Therefore, they don't adjust inventory. Merchandisers, they might have to adjust inventory. Why? Because the inventory might be different than the actual count. So let's take a look at how do we adjust inventory. Suppose that PW Audio Supply has unadjusted balance of $40,500 in merchandise inventory. So simply put, they looked at their record and they looked at their general ledger merchandise inventory, and the system is showing them they should have $40,500. So what they did, through a physical count, they determined that the actual inventory is only $40,000. Well, hold on a second. Don't we update merchandise inventory continuously? And the answer is yes. But if someone stole inventory, if the inventory is damaged, basically lost somewhere in the system, we're not aware of it, especially if it's a stolen. When someone steals something, they're not going to pass by the register and say, could you please scan it so the inventory is updated? They don't do this. So the only way to know if something is stolen is to count the inventory on a regular basis. So yes, even a perpetual inventory system, you would still count your inventory. You would still count your inventory. Why? Because if there is any loss, theft, damages, you would need to do so. So what's going to happen? Now we need to reduce our inventory. We need to reduce our inventory by $500. So we reduce inventory. We credit inventory by 500. Therefore, let me just do this one down here. So merchandise inventory, we said we had 40,500. We need to reduce it by 500. Now we have exactly 40,000. And this is what we need. Then for every debit, you need a credit. So you reduce your inventory, and what happened is that's a loss. You took a loss of $500, debit cost of goods sold. Closing entries are the same. What does it mean? The same. Step one, close revenues to income summary. For example, if you have revenues of $480, you debit revenues. Again, I'm not going to go through this again. Go to the prior session and you will see the closing. Step two, close expenses. Now we have to be careful here. We have three new account here that we did not see in the prior session. Three new account. Two of them are considered contra revenue. So contra revenue are treated just like expenses. And this is a new account, cost of goods sold. Cost of goods sold is an expense. So contra revenues are treated just like all the other expenses. Remember, anything that goes on the income statement is subject to closing. Then we have income summary of 30,000. How did I come up with income summary of 30,000? I have revenues of 480. I have expenses of 450. Therefore, income summary is 30. I debit income summary and I transfer the amount to retained earnings. Then I have 15,000 of dividend. I credit dividend, debit retained earnings. Simply put, it's the same as the other the service company. Let's take a look at this. So the trial balance of Celine Sportswear shop at December 31st show inventory of 25, sales revenue 162,400, sales returns and allowances 4,800, sales discount, cost of goods sold, rent revenue, freight out, rent expense, salaries and wages expense. So prepare the closing entries. That's what they want us to do. Remember, the first step is to close all your revenues. So we have sales revenue, and we have, do we have some other revenue? I think I saw another revenue, rent revenue. So we have two revenues here. They sell and they rent some product. So therefore, you debit sales revenue, you debit rent revenue, and you credit for the difference income summary. The next thing you do is you close all of your expenses, including sales returns and allowances and sales discount. So we have sales returns and allowances, sales discount, cost of goods sold, freight out, rent expense, and salaries and wages expense. So what you do for the rest, you debit income summary for the total of these amount. Okay, so this is the total of these amounts, and the total is 151, and the revenue had the total of 168,400. The difference between them will be the closing to income summary which is we don't go through this, but if we want to close income summary, we would have closed income summary. Simply put, the journal entries are the same. Just be careful that you have cost of goods sold, sales returns and allowances, and sales discount, and kind of freight out too, a new account. But remember, freight out is an expense. It's different than freight in. If you have any questions, any comments, by all means, email me or see me in class. If you're studying for your CPA exam, as always, study hard. It's worth it.